You're watching the chart go straight up, headlines are screaming short squeeze, and everybody suddenly sounds like a genius. But right around $94 is where a lot of traders get absolutely wrecked. Not because the company suddenly changed overnight, but because the game changes when a squeeze goes vertical. The same move that feels like easy money can flip into a trap so fast you don't even get a clean chance to react. And if you've ever said, "I'll just sell when it starts dropping," I need you to hear this. In squeezes, the drop doesn't always start gently. Sometimes it's a trapdoor. So in this video, I'm going to walk you through why $94 can become the danger zone, what they're setting you up really means in plain English, and the exact psychology that turns excited buyers into exit liquidity. And no, I'm not here to tell you to buy or sell anything. This is general market education, not financial advice, because squeezes are high risk and everyone's situation is different. But if you're in this trade, or thinking about jumping in late, you need a plan before the chart makes one for you. Also, real quick, if you like breakdowns like this, simple, direct, and focused on what actually happens during these violent moves, hit the like button and subscribe within the next few seconds, because it helps the channel a lot, and it tells YouTube to show you more content like this when the next big move hits. Now let's get into it like a story, because that's how these squeezes always play out. Act 1 is always the same. The stock is ignored, hated, or heavily shorted. People clown on it, analysts call it dead, and shorts get comfortable. Then a catalyst shows up. Earnings, guidance, a rumor, a surprise partnership, a regulatory headline, a product update, anything. Price starts moving up, shorts start feeling heat, and the volume comes in. At first it looks normal, and then it doesn't. Then Act 2 hits. Momentum traders arrive. Social media starts posting screenshots. Everyone begins talking in price targets, not probabilities. The stock starts gapping. And this is where the word short squeeze becomes dangerous because it makes people think the move is guaranteed to continue. But a squeeze isn't a magical elevator that only goes up. It's a pressure release valve. It can blast higher and it can also snap back with the same violence. Here is the key idea you have to understand. The market doesn't move like a single crowd of people all clicking buy and sell at the same time. There are different players with different tools. You've got long-term investors, day traders, swing traders, algorithms, market makers, and funds that are hedging in ways you can't see on a simple chart. When I say they, I'm not talking about some cartoon villain in a dark room. I'm talking about the structure of the market, liquidity providers, option hedging flows, and big participants who know exactly where most retail traders place entries, stops, and profit targets. And that matters because levels like $94 are not random. Big roundish levels, prior highs, major strike prices in the options chain, and everyone sees it, numbers become magnets. And when price approaches those areas, the market turns into a battlefield. It's not just about whether the company is worth it. It's about positioning, leverage, and who needs to get out versus who can afford to wait. So why is $94 such a dangerous number in a vertical squeeze? Because that's often where late buyers pile in and early money quietly starts distributing. Think about it. Early buyers are sitting on huge gains. Shorts are under pressure. Options traders are forcing hedging. The chart looks unstoppable. That is the moment when people who were too scared at $60 suddenly feel safe buying at $90 because now it proved itself. And that's exactly when the risk flips. Let me ask you a question and be honest with yourself. If you missed the move from $40 to $70 and then you see it rip from $70 to $90 in a flash, what does your brain want to do? It wants to chase. It wants to just get in before it's too late. That fear of missing out is not a character flaw. It's human. But markets punish emotional timing. Another question, if you're already in profit, what's your plan at $94? Not vibes, not diamond hands, a real plan. Are you taking some off? Are you moving risk? Are you okay if it drops 20% in 5 minutes? Because that's not an exaggeration in a squeeze. That's Tuesday. Now, when people hear crash, they imagine a slow fade. But squeeze crashes often look like this. A sharp rejection, a fast drop, a bounce that gives hope, and then another drop that's even faster. It's like the market is shaking people out in layers, and it's incredibly effective because it attacks both kinds of traders. It scares out weak hands on the first drop, then it traps dip buyers on the bounce, and then it dumps again when the crowd feels confident. That's how a vertical squeeze goes from legendary to I can believe I didn't sell. So what are the warning signs as we approach that $94 zone? First, pay attention to how price behaves when it gets near the level. Does it slice through like butter, or does it start stalling with long wicks and sharp rejections? In a healthy momentum move, you'll still see pullbacks, but they tend to get bought quickly and price makes clean progress. In a distribution zone, you'll see something different. Price struggles to hold gains, rips up and immediately sells off, and the chart starts feeling jumpy. Second, look at volume relative to progress. If volume is exploding but the stock isn't moving higher the way it was, that can be a sign that buyers are getting absorbed. In plain English, it means a lot of buying is happening, but someone is willing to sell into it. And when that selling pressure finally overwhelms demand, the air pocket shows up. Third, watch the emotional temperature of the crowd. When every post becomes, it can't go down, when people stop talking about risk, when the entire conversation becomes price targets with no plan, that's usually late stage energy. The market loves to punish certainty because certainty attracts leverage, and leverage creates forced selling when things go the other way. And here is the part nobody wants to say out loud. The most dangerous time is not when the stock is weak. The most dangerous time is when it's strong and everyone believes it's safe. That's when you get set up. So in part 2, I'm going to explain what's really happening under the surface. Shorts, options, gamma, hedging, and why moves can go vertical one day and then implode the next. And then, in part 3, we'll talk about how to survive this kind of trade mentally and tactically. Because the squeeze doesn't just test your account, it tests your decision-making under stress. Let's pull the curtain back and make this simple. A short squeeze starts with short sellers. A short seller borrows shares and sells them, hoping to buy them back later at a lower price. If the price goes up instead, they're losing money, and at some point, they may be forced to buy back shares to close the position. That buying can push the price up even more, which forces more shorts to buy. That's the squeeze feedback loop. But here is what most people miss. Not every short is forced out at the same time, and not every short is wrong. Some shorts are hedges. Some are long-short strategies. Some have deep pockets and can sit through pain. Some are trapped. And the market doesn't tell you which is which in real time. Now layer in options, and this is where the went vertical part usually comes from. When a ton of call options are bought, market makers often hedge by buying shares. As price rises, they may need to buy more shares to stay hedged. That can create a gamma squeeze, where options flow accelerates buying pressure. That's why the move can look unnatural, like the stock is being pulled upward. So as the price climbs toward a level like $94, you often have multiple forces colliding. Shorts are watching risk limits. Options hedging is reacting to price. Momentum traders are chasing breakouts, and social hype is pulling in brand new buyers. That combination can drive insane candles, but it can also create a fragile structure because the move is being powered by flows that can reverse fast. Here's a key point. Forced buying can turn into forced selling. If the move up is powered by leveraged traders and short-term options, then when the stock stalls or drops, the same participants may unwind. Call buyers take profit. Market makers reduce hedges. Momentum traders hit stops, and suddenly the bid disappears. That's when you see those brutal red candles that feel like the floor vanished. Now let's talk about why $94 specifically can become a setup area. In squeezes, certain prices become crowded. A lot of traders place their breakout buys just above obvious resistance. A lot of traders place their stops just below obvious support. And a lot of traders place take profit orders at obvious numbers. When too many people cluster around the same map, it becomes easier for the market to create a move that hurts the maximum number of people. One common pattern is a breakout tease. Price rips toward the level, everyone gets excited, it pokes above, triggers breakout entries, and then it slams back down. That move does two things at the same time. It brings in fresh buyers at the worst moment, and it triggers stops for people who bought earlier and tried to give it room, but not too much room. That combination creates a fast dump. And the reason it feels like they set you up is because it's systematic. It's not personal. It's what happens when liquidity is hunted. Big moves need liquidity. If a large participant wants to sell a lot of shares into strength, they need buyers. Where do they find lots of buyers instantly? At the exact moment retail feels the most confident. Right after a breakout, right after a big green candle, right when it's confirmed. Now, could it still blast through $94 and keep running? Absolutely. That's why this is hard. There's no certainty here. But the risk is asymmetrical when you're late. If you're buying at $92 hoping for $120, you might be risking a sudden flush back to $80 or $70, and in a squeeze that flush can happen before you even process what's happening. Your risk is not what you think it is, because your fill on the way down may be much worse than your mental stop. Let's also talk about something that adds gasoline to both directions: halts and liquidity gaps. When stocks move too fast, they can get volatility halts. That pause feels like a chance to breathe, but it can also be terrifying because you can't exit during the halt. When trading resumes, price can gap down instantly, and your plan has to account for that reality. Another factor people ignore is supply. Supply can show up in different ways. You can get dilution, where the company issues shares. You can get convertible note dynamics. You can get insiders or early investors selling after lockups. You can get funds rebalancing. And you can get shorts that are actually adding into strength because their strategy is to fade euphoric spikes. Again, not saying any specific thing is happening right now, just explaining how these moves often end. Now I want to address the word crash at $94. The crash isn't a T guaranteed, but the setup risk increases when three things happen at the same time. Price goes vertical, sentiment goes euphoric, and the options chain gets overloaded at nearby strikes. When that happens, a small change in direction can turn into a big move because positioning is crowded. Crowded trades don't unwind politely, so what can you watch in real time without needing fancy tools? Watch how price reacts after big green candles. Does it hold gains, or does it immediately give them back? Watch the rhythm. In a strong squeeze, pullbacks tend to be shallow and quick. In a topping squeeze, pullbacks start getting deeper, bounces get weaker, and the chart starts making progress in bursts, followed by heavy givebacks. Also watch how people talk. Are they asking, where's the risk? Or are they saying, this is free money? The market loves to humble the second group. And let me ask you another question. If you're holding, is your plan based on your account or based on what strangers are chanting online? Because this is where people confuse community energy with a risk plan. Community can be fun, but the market doesn't pay you for loyalty. It pays you for timing and risk control. Now, why do squeezes often fail right after they look the strongest? Because the final stage is usually the widest distribution stage. Big players don't dump everything in one candle. They sell into strength. They let price push higher, sell a little, let it push again, sell more. That creates the illusion of endless demand, until demand finally runs out. When it runs out, there's no cushion because everyone who wanted to buy already bought. And then comes the part that hurts, the bounce. The dead cat bounce, the hope bounce, whatever you want to call it. Price drops hard, then it bounces, and that bounce convinces people the worst is over. Late buyers average down, some shorts cover, and the chart looks like it's stabilizing. Then the second leg down hits, and it's often worse because now the crowd is emotionally anchored. They don't want to accept they bought the top, so they hold longer, which delays selling until panic forces it. If you want maximum retention in this video, stay with me through part 3, because I'm going to give you a simple mental framework for trading around a violent level like $94 without getting hypnotized by the candles. Not a get-rich plan, a survival plan. Because surviving squeezes is how you stay in the game long enough to actually win. Here's the truth about squeeze trading. The chart is not just price, it's emotions. It's hope, fear, ego, regret, and adrenaline, all fighting in real time. And the reason so many people get crushed near levels like $94 is not because they were dumb. It is because the market is designed to pull you into decisions when you are least capable of making calm choices. So let's make this practical. If you're already in the trade and you're up big, the question isn't, how do I maximize every penny? The question is, how do I avoid turning a win into a loss? Because that happens constantly in squeezes. People go from up 40% to flat because they wanted up 60%. Then they go from flat to down 20% because they didn't want to admit the move changed. One of the cleanest mindset shifts you can make is this. You don't have to sell the top to win. You have to sell in a way you can live with. And the market will try to make you feel stupid no matter what you do. If you sell and it keeps going, you'll feel regret. If you hold and it dumps, you'll feel pain. The goal is to choose the kind of regret you can tolerate and build a plan around that. Now, if you're not in yet and you're watching $94 like it's the last train, I want you to pause and ask, what is my edge entering here? Not because it's going up. That's not an edge. That's a description. Your edge could be a breakout with a clear invalidation, a momentum strategy with strict risk, or a longer-term thesis that can handle volatility. But if your plan is, I'll just buy and hope, then you're not trading. You're donating to volatility. A simple framework you can use around a level like $94 is to think in scenarios instead of predictions. Scenario 1, it cleanly breaks above, holds, and continues. Scenario 2, it breaks above, fails, and dumps. Scenario 3, it chops and whipsaws, shaking out both sides. Your job isn't to guess perfectly. Your job is to decide what you will do in each scenario before you're emotional. Because once it starts moving fast, you will not think clearly. You'll think in fragments. What if I miss it? What if it goes to 0? Everyone says it, S going to 200. And that S where people get set up, they confuse speed with safety. Let's talk about risk and squeeze conditions in a way most people don't. Your real risk is not just the distance to your stop. Your real risk includes slippage, halts, and the fact that a gap can ignore your plan. That's why position sizing matters so much. If the position is so large that a sudden 15% drop will make you panic sell at the worst possible moment, then the position is too large for you, even if it looks fine on paper. And I know some people hate hearing that because it feels like being told to be boring. but boring is what keeps you alive in a market that can change character in 60 seconds. Now let's address the psychology of the $94 trap specifically. When price approaches an obvious number, traders often do one of two things. They either take profit right before it, causing the move to stall, or they buy right at it, expecting a breakout, which creates a pocket of buyers who can be trapped if it fails. Either way, volatility spikes near the level. That's why your decision making has to be cleaner there than anywhere else. If you're holding into $94, ask yourself this. If the stock rejects hard from that area and starts dropping, what is my signal that the move is over? Is it a break of a prior support? Is it a failed reclaim? Is it simply, I'm uncomfortable? There's no perfect answer, but I'll figure it out later is the answer that usually ends in panic. Also understand this. Squeezes don't end when the last short covers. They end when the marginal buyer disappears. The move continues as long as new buyers are willing to pay higher prices. When the crowd is already all in, there's nobody left to push it. That's why the final stage often looks like crazy spikes and wicks. It's price searching for buyers. Now, some of you are thinking, okay, but what if this is the real one? What if it goes way past $94 and I sell too early? That's a fair fear. So here's a middle ground approach many traders use conceptually. Instead of making one all or nothing decision, they reduce risk as the move becomes more extended. That can mean taking some profit on the way up, or tightening risk, or simply lowering exposure so your emotions stay under control. I'm not telling you what to do with your money, just explaining how people avoid the common squeeze mistake of turning a winner into a disaster. And if you're using options, please respect how violent they can get in both directions. Options can amplify gains, but they can also lose value fast from volatility shifts, time decay, and sudden reversals. A lot of people focus on being right about direction and forget they also need the timing and the volatility to cooperate. Again, not advice, just a reality check. Let ES bring it back to the warning. They are setting you up for a crash at 94. Interpreted the right way, it means this. The market is setting a stage where the most obvious, most emotional decisions happen. Chasing late, oversizing, ignoring risk, and assuming a breakout has to work. And when the crowd lines up to do the same thing, the market often does the opposite, at least temporarily, because that's where liquidity is. So what should you watch right as it gets there? Watch whether the breakout holds or instantly fails. Watch whether dips get bought quickly or whether buyers hesitate. Watch whether price starts printing big wicks and rejecting repeatedly. Watch whether the stock can reclaim the level after a rejection or if every bounce gets sold. Those clues won't give you certainty, but they will give you information. And most importantly, watch yourself. Are you calm or are you refreshing the chart like it's a slot machine? Are you thinking in probabilities or are you thinking in prayers? If you feel yourself getting emotional, that's not the time to increase risk. That's the time to slow down. Now, I want to hear from you because this is where the best insights show up. Are you currently in this squeeze watching from the sidelines or did you already trade it? And what do you think $94 represents? A breakout launch pad or a bull trap level? Drop your thoughts in the comments. And if you've got a specific plan you're willing to share, like what would confirm strength for you and what would confirm weakness, post it. People learn a lot when they see how others think, not just what others predict. And if you know someone who's about to FOMO in because the chart went vertical, share this video with them. Seriously, it might save them from learning an expensive lesson the hard way. Thanks for watching, and stay sharp around that $94 zone, because in a squeeze, the biggest candles can also be the biggest warning.